Hello, guys, and welcome to an IQ option webinar on money management strategies. We'll discuss more in detail about the strategies that we can look into when trading, in regards in focusing more to do with managing a balance, looking more into the position amounts and how to manage a balance over a long period of time. A lot of people push this to the side and focus more on technical and fundamentals in regards to this. But I want to speak exactly more to do with how important money management strategy is for trading. Before we start, I know you guys are a bit bored up until this point with disclaimers, but it's something we have to go through with. So before I begin, I'd like to let everyone know that this is a presentation specifically to help other people increase their knowledge in how money management works, how you can incorporate this into your trading. It's by no means a strategy that is 100% guaranteed or anything like that. So it's an educational webinar in regards to this. Uh, I'd like to say a quick thing as well. Feel free to write down any questions. I see a lot of people are active on chat, so I'm very, very happy with that. Write down any questions or any feedback that you guys have apart from the technical issues. And I'll try my best to answer as many as possible at the end of this webinar. Um, Perfect. Now, what I'd like to discuss more of is the importance of money management, a few strategies that you can use for money management, fixed strategies, and the emotional impact that this has on traders. Another very, very important topic that goes very, very well with money management. Now, why is it needed? The main principle for money management is and how important it is when trading, it helps manage a balance. It helps you manage the balance, it helps you grow a balance, and it helps limit losses if used correctly, knowing when to stop, knowing when to start trading, and how much you would be placing for each position. So, according to my experience with working with many traders, uh, it's a key factor in using while trading, especially it being a good one as well. So before we get into the calculations and a few numbers that we can crunch up for each and every individual, um, it's very important to trade with confidence. Everyone should be trading with confidence. Know what you're trading. Analyze the markets with technical and fundamental analysis. After you've done this, money management comes into play. How much do we put into this position? How confident are you that this market will hit your predictions? Don't negotiate with yourself. Don't negotiate with yourself or the market throughout this trade. So, as an example, after this slide, I'll show you an example, and I'd like to know how many traders can relate to this specific scenario that I'm going to be mentioning in a few seconds. There we go. This is just one scenario that of a trend in a market. Now, you place a call position right where the green arrow is. You see the markets, you wait for a while, you see the markets shoot up. Now you're in a profit. You wait a bit longer, you want to keep that position. Um, you've got a feeling that it should shoot up according to your technical analysis or fundamentals. And the markets do. They shoot up. Now you're in even greater profit, in an even greater profit. How many of you would start selling that position, would start closing down that position at that specific point? I want you to think about it a bit more because it's a very vital point when you're looking into a trend exactly like this. We've seen a trend like this many times. Let's keep the trend going. You see that it shot up higher. So you're looking at much bigger profits at this point. How many of you will be selling at this position? Have a rough understanding of how this market is going through. Now, this is the point where I'd like to speak about more in detail. The market starts shooting down. Now, when the market starts shooting down and you see this level, so you've reached a profit which is in the thousands, and you're waiting for the markets to shoot slightly down. The markets have already shot sliding down. So you've lost a significant amount of profit. I said a phrase before a few slides: don't negotiate with the markets and don't negotiate with yourself. So at this point, what many traders would do is they would wait for the lowest point. They did the mistake in not selling, so they would wait for the lowest point, and then questions start arising. Uh, let's wait a bit more to hit a slightly higher profits, and I'll close at that point. I'll be happy if the markets go up to that point, and I'll close it down. Let's just wait a bit more. Now, the markets don't really care what you're saying, what you're thinking about, and what you want. So this is where a good money management strategy comes down to. If you had your stop loss, if you had your take profit, if you knew exactly what you wanted and what you were expecting, that's when you would have already closed down this position. Now, you're waiting, since you've negotiated with the markets, you're waiting for that price to go up. This can be for either digital, it can be for forex, not mainly to do with binary, but the reason I'm speaking about this example is because it's so it- it's for a lot of people that I've already spoken to as traders. It's something that goes through your mind no matter what you're trading. Um, so you're negotiating with yourself. You're waiting for those profits to go up. They don't go up. So that little tiny bit higher that you wanted for waiting for the markets to go up, they don't give you that. The market doesn't give you that. So what does the market do? It shoots down. So from your initial point of call position, a buy position, it shoots up where you could have gotten substantial amounts of profit, even if you sold at the $2 sign. Um, and you close down, you would have been much better off if you waited after you've negotiated with yourself. And this is the exact scenario that I want to get through to traders. It's very important. And this is what I mean by negotiating with yourself. Now, a quick point of view is to help in this is never ever no one ever declared bankrupt with profits, whether it's low amounts of profits, whether it's high amounts of profits, it's still a profit. Okay, so if you get smaller profits than you've expected, but you have a feeling, or your technical analysis or your fundamental analysis says that it should shoot down, the market should shoot the opposite direction, it's still a profit. Close it down, do your analysis and technical and fundamentals for another trade. It's always better losing an opportunity than losing money on a trade. Very important. Analyze the, as I said, analyze the markets, make your decision, and take your decision. Be very decisive. Always apply limitations. After this example, I'd like to speak about two different types of traders. Um, Now, this is extremely important, especially when you're looking at money management and when you're looking at trading in general. I always get this misconception that people think aggressive traders are bad, or conservative traders don't make a lot of profit. It, it's nothing to do with this. So when we're looking at aggressive and conservative traders, what type of trader you are doesn't necessarily mean that it's bad if you're aggressive, or it's good if you're conservative. Nothing at all. Nothing like that at all. This will give you a general idea of exactly what type of strategy you should be using. So if you're an aggressive trader, acknowledge that you're an aggressive trader and work in terms of that. If you're a conservative, if you feel like you're pushing towards more of a conservative trader, work with that. Acknowledge the fact that you're a conservative trader and work along that line. Give yourself a strategy that links up to what type of trader you are. Let's look at a few characteristics on what an aggressive and what a conservative trader actually is, so that you can differentiate the two. There we go. So we've got a screenshot of a market. Now, an aggressive trader, the characteristics of an aggressive trader is big amounts per trade. You tend to place bigger amounts. Um, you enter the market slightly quicker than you should. As you can see from the chart here, you see an uptrend, you quickly want to get into it. You quickly want to get into you want to secure as much profits as you can. It's not a bad thing. It's not necessarily a good thing or a bad thing. We just need a strategy that works in combination with this style of trading. Aggressive traders tend to not wait for a signal from a technical point of view. For example, if you've got two moving averages and you're waiting for them to cross so that you can place a position, a lot of aggressive, and I know quite a few traders do this, a lot of aggressive traders or traders in general, that they will place the position before that crossover, before that overbought signal, before that oversold signal. And aggressive traders, they tend to trade against the market very, very often. Moving on to the conservative traders, it's exactly the opposite. We're taking, by the way, two extreme difference in characteristics, the aggressive and the conservative. So you see with the conservative, you're waiting too long. You do place steadier amounts per trade, but that doesn't necessarily mean that it's good, because you may be placing lots of amounts within the same expiration time. Conservative traders tend to be late a bit in the market, so they see the movement happening, they wait for that confirmation, or they overwait for that confirmation, and then they would place the position. And the method of trading doesn't change too much. So once you find a strategy, you tend to stick to it for a long period of time. Now, as I said before, don't see this as a downside, conservative or aggressive traders. Look at this as an advantage. Use it to your advantage when you're trading. It's not bad or not good uh, depending on what you are. Just acknowledge what type of trader you are and work your way around that. Now, we've given two topics of with examples on traders and a scenario in trading. I'd like to crunch down a few numbers. Uh, we can all do this. So whoever's looking at this slide, you will be able to figure out what number best suits you. Since money management is different for every individual, we will have to figure out what your specific number is. For example, $500 for me might be a lot of money, crazy amounts of money, something that I don't spend that much. Uh, it'll take me a long time to spend that much money. Now, for you as a trader, $500 might be nothing. It's still $500, however. The value of it is very different for me and for you. So we can't look at, I do talk to a lot of traders that are dealing with, I trade 5% of my balance on a daily basis. I trade 10%, I trade 6, 2%. You're talking about percentages. Now, that percentage might be okay for you, but it might not be okay for me or any other trader. And when we're looking at percentages, we then get to the other impact, that is emotions. 5%, yes, but of what balance? Of $100? Of $1,000? Of $10,000? So a trader that's used to, in his comfort zone, trading with a balance of $100, if we give him a balance of $10,000 and I tell him to trade with that exact percentage, it's going to bring out a whole new emotion for him. He's not trading with ones and twos and $3 now. He's trading with hundreds per trade. So if he starts losing those hundreds, it's 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 called either revenge trading, it's called emotions. So we're going to try and figure out what we can do to prevent that. I'd like you to analyze your day-to-day general spending. So how much do you spend per day? For some people it might be $15. For some people it might be $60. For some people it might be 120, 1,200. It differs for each and every person. Now, we're working with day-to-day spending so that we know what is our limit for the day. And you tend to divide that number by 3, 4, or 5. Now, this is just a general rule of thumb. Okay, for some people this number might be too low. For some people day-to-day spending differs, but this is just a rule of thumb. You can work with this concept, with this logic, for your numbers. So a general example: if me personally I spend $60 a day, either for my coffee, either for shopping, either for clothes, whatever, um, either for cigarettes, anything. So if my general spending is $60 per day, and I have a risk appetite of, let's say, 3, if I want to bump it up, 4 or 5. So if I divide that 60 by 3, I know that $20 is okay for me to risk. I'm good with risking $20 to make more profits. It won't affect, I won't go bankrupt. I know that $20 I can manage. I can manage with $20. So that is my risk appetite for per day, $20. It covers some of my day-to-day basis, but I'm not going to make a loan to trade. I'm not going to increase my values so that I can make up for my losses. I know that $20 is my limit for the day. Don't exceed this amount on a day-to-day trading session. So we can all do this calculation. You can think about exactly what your day-to-day spending is, divide that by a number of maybe 3, 4, or 5, and figure out your numbers. Now, uh, I'm going to speak about 3 major money management strategies that are being used for binary. Mostly binary, digital, sometimes in Forex. It's not very popular in Forex, but sometimes in Forex. Martingale, compound strategy, and fixed amounts. I'm pretty sure everyone is aware of how they work. I'll just give you a crash and a breakdown of how everything works within these specific strategies. Now, Martingale, as some of you know, it can be very risky. It can turn bad very, very quickly when you're using Martingale. It's a money management strategy mainly used for binary. As I write here, it is extremely risky, as some of you know. So use with caution. You don't using Martingale, for some people it works, for some people it doesn't work. Now, it will increase emotions while you're trading. Number one factor that a lot of people lose money when trading: emotions. Martingale will thrive on your emotions. You're starting with $1. By the end of the trading session, you might be up to $1,200. It generates emotions. One thing that we don't want while trading. You need your limits. So any consecutive losses with Martingale, have a limit on how much you're doing it, and start with a low number. Um, so many traders that I speak to, uh, they keep telling me that they're starting Martingale with $10. I mean, if you're multiplying that by a coefficient, within 3, 4, 5 consecutive losses, you're in a huge amount. We don't want that. We want to take it easy, take it slow. I'll tell you exactly how to apply this. Now, yes, I can see from chats Martingale is not good, isn't good at all. Very good. If it doesn't work for you, by all means, do not use it. I don't tell traders to use Martingale. It's for very limited people, limited a number of people that want to work with such a strategy. So by all means, this is not something that I force people to use, or it's a good money man strategy. It's very risky, as a lot of people know. Uh, we can change a few settings. If someone decides to use Martingale, we can change a few settings on the platform with our calculator, inbuilt calculator. So once you click on amount, you've got a little picture down the bottom of a calculator. Change the coefficient to roughly around 2.5. So every loss that you're doing will increment that amount by 2.5. Your initial value is 1. Multiply that by 2.5. Your next position is 2.5. Multiply that by 2.5 again. Your next position is 625. Now you can see how fast we're increasing these amounts. From the initial value of 1, multiply 6.25, you're up to 15 now. Multiply that by 2.5, you're up to 39. And this just keeps going, keeps going, keeps going. That's how you would be able to change the settings on your platform so that you can do it much, much easier, not go through calculations or calculators. There we go. This is the second strategy that a lot of people use when trading binary, compound trading. It is very similar to martingale, but the inverse. So you will not be increasing amounts when losing a trade. You will be increasing amounts when winning a trade. Again, with the same concept, you put in $1. If you're successful with that $1, your next trade is $1.80. So in essence, you're risking that $1, your initial $1, for an increased amount of profit. I would not recommend you going over 2 or 3 consecutive trades. So don't overdo it, because at that point you're risking too much. So if you have 2 consecutive trades with the compound, stop and start again from $1. 2 or 3. This is how we'd be able to apply it exactly with the same concept for martingale. You can use it for your compound trading as well. Click on your amount, click on the calculator, and change the coefficient according to the percentage. So let's say, for example, we have 88%, as this screenshot says here. My coefficient will be 1.88. Multiply that. As soon as you click on that multiplication, that amount should be changing. Then you place your higher or lower position. Fixed amounts. A lot of traders find this very, very nice in accordance to martingale and compound. Fixed amounts is very, very familiar amongst traders, and it's pretty much the more standard way of trading, which is a good thing. You're not incrementing amounts when you're losing positions. You're not incrementing amounts when you're winning positions. What you need when using fixed amounts, you need a good analysis, technical, fundamental. The only way to generate more profits, a lot of profits, is to have more successful trades than unsuccessful trades. You hit that roughly 63%. If you're hitting 63%, 62, depending on the profit percentage that the platform is providing at that day or time, if you're hitting 60, roughly around 60% successful trades, you are making good profits. You're generating good profits. But we all come back to the same thing as we mentioned before: patience and confidence. Patience to wait for your signals, confidence to know when you're closing down that position or when you're entering or exiting trades. So we're moving on to the emotional impacts when you're trading. Um, in terms of emotional impacts, there's 3 things that I'd like everyone to know. And a lot of people will make their own links as well with these 3 topics under emotional impact. It is very, very important. And the reason behind this webinar, the reason behind everything that I'm discussing today, is to lower down these emotional impacts. If you have a good money management strategy, you should not get, should is a very strong word, but you should not get into that emotional mindset, that mind frame where you've lost a lot of money and you have to generate more. Revenge trading, open up bigger positions that you're not comfortable with. We want to lower down these risks. We don't want to go through these. Now, um, uh, it's very important to be in the correct mindset, as I mentioned, when trading. So rules need to be set, setting your own rules. We need to stick to a logical growth, a stop loss limit. I use stop loss. A lot of people are familiar with it in Forex, but stop loss, for example, the way I mean it is having a limitation on your losses per day and a limitation on your profits per day. Know exactly what you want out of the market and stick to it. Now, the reason I say this is, again, I speak to a lot of traders that are fighting for that 5% growth every day. Guys, we have 365 days in a year. You are not going to be hitting those 5% every single day for the year. Look at it as a long-term growth. I mean, if we get a basic example on this, the average here that the bank will give you on an interest rate on your savings account is about one point something percent annually. That's steady growth per year, keeping your money in the bank without doing anything to it, and you get a fixed amount of one point something percent. Now, why are we fighting for an exponential growth of 5% per day? It's not logical. There are days and there are times when you're trading that you're not going to be doing so good. So have limits. If you're not having a good trading day today, for the next 3 days it might be good. So you're going to be making up that one day of bad trading. Stick to logical growth. The other point is understanding fear. Now, okay, I'm seeing here a question of how much is logical growth. Uh, Now, logical growth, you cannot set a specific number on that. It's exactly what we've mentioned before in terms of, if you're looking at logical growth, you have to look at the logical numbers that you're using to trade. This is exactly why I've added the topic, know your numbers. A logical growth for me can be $500 a day. A logical growth for you can be $10,000 a day, depending on what you're trading. But don't try and trade a $10 balance and have a logical growth of 10,000 per day. It's this is where I gave an extreme example, of course, but this is where we're coming to. If you're trading with a balance of, let's say, my day-to-day spending is $60, I am willing to risk a division of 3 on that 60. So what am I willing to risk? 20. So we go on through 20. If I lose 20 per day, it hasn't affected me this much for my day-to-day spending. I can survive. I can eat. I can go for a coffee. That's okay. Now, if I'm making and this is where the logical growth comes in to play. If I'm making an amount, a specific amount, in which my risk tolerance, for example, might be, I want to be making $30. That's a logical growth. If I turn around and say I want to be making $200 with that $20 risk that I've got, it's not logical. So that's the way that you should be thinking about. Around double that, maybe even less. You want a very low risk. Maybe you want to be placing 5 trades a day. It depends entirely of your style, the way you want to be trading. Uh, let's move on to understanding fear. Now, fear plays a very big role when you're trading. Some fear the release of maybe news impacts. We have the G20 meeting today. All currencies are being affected with this G20 meeting. Some people will step away from it. They won't mention it. Okay, there's a very big meeting. There's a very big fundamental news today. I'm going to step away, or maybe close down all my positions, or maybe not trade for the day. Some traders take advantage of these fundamental news, of these fundamental analysis. Now, it depends on what your comfort zone is. But try a lot of people that don't take advantage of fundamental news, most of them don't know how to use it. Analyze the actual values, compare them to the forecasted values, see what news and what currency is impacted. What are you going to trade today? Euro USD? What do we have on Euro USD? It's just this analysis that if you do before entering a trade, you understand the markets more and you're lowering down the fear. Now, it is also personal preference. Some people don't like trading on fundamental news. So as soon as they see fundamental news, they completely and entirely avoid it. But we have to be open-minded when we're trading. We have to know, uh, study, know what fundamental news, how it works, and then if you don't like it or if you like it, you can continue using it. Same with technical, same with anything that we're using for signals. Overcoming greed. This is another very, very big topic that we can discuss. I'm trying to to not take too much time. Um, so I'm just scraping the surface of these topics, but they are incredibly big topics that you have to be looking into. Um, Greed, a very big impact when you're trading. Some people make good amounts of money, good amounts of profits in a day, $1,000, $3,000. Now, what happens in a few minutes? What happens in the next half an hour or 1 hour? They blow their account up. We don't want to be working with fear. Stick to that limit that you've got, make those profits, and if it's working enough for you, continue trading with a limited amount. But you've reached your goals for today. Why push it? Why risk your whole balance so that you can get an extra 200 or an extra 300? So this is a very big subject. Greed. Greed goes directly with revenge trading. You're opening up a position, you lose that, you want to make that up, you're increasing your amounts, and it just keeps going. It's not a very good formula to be trading with. Very, very bad. Now, those are basically all of the topics. I tried mashing the most important topics into one presentation. I do apologize that I've taken so much time, and I do apologize about the early technical issue we had. But I've tried to compile the most important subjects and topics into one presentation. Uh, as a quick conclusion, what we've discussed and what we've talked about, um, money management strategy is compulsory. You need it when it comes to trading. Very, very important. Don't take it for granted. Spend the next half an hour calculating your numbers. Spend the next week analyzing and testing. Know what type of trader you are. Some people don't get really into details with this, like know what type of trader you are, what's my characteristics, what's my emotions. Think about them. Yes, we need to get into more detail. You need to know yourself in a circumstance like this when trading so that you know what strategy to use so that you can work with yourself, work with your emotions, work with your feelings. um, Now, one last key factor that I'd like to discuss, to mention: patience and discipline. You need to be patient to uh, wait for the right signals, to study material, study how technical indicators work. You're using one strategy, it's not working, study another one. All this needs patience. Wait for the entry point and for the exit point of the signal that you've analyzed. And discipline. If you've got discipline, you know when to stop, you know when to limit, you know when to decrease those emotional impacts that comes with trading. Now, that's basically it. I've spoken about all the topics that I'd like to discuss with you for today. Um, so thank you so much for your time. I hope I answered. I hope I got a few questions from chats. We've got a question here: if going all in on a perfect signal, a good money management strategy? um, no, that defeats the whole purpose of everything we spoke about today. uh, Gradual increases. So if you've got a big amount of balance, uh, drag it out. You don't need to trade that balance in a certain specific amount of time. Drag it out. Don't focus too much on that. Now, uh, as I mentioned, I do apologize about the early technical issues we had. I hope everything's fixed for the future webinars. We're going to be speaking about a lot of topics that um, hopefully help you guys. Now, if you do have any feedback, if you want to listen to specific webinars on specific topics, Guys, let us know. We need material to speak about. We need your help so that we know what to speak about and share with you guys. So I hope this webinar helped. Contact your account managers if you need more information on a specific topic that we discussed today. And I wish you guys a very, very good weekend.